The investor's dilemma, complexity, and fear. Many people want to build a secure future. They work hard, they save their money diligently, yet when it comes to making that money grow, they often stop. The world of investing seems complex and dangerous. It is filled with confusing jargon and fast-moving charts. People hear stories of fortunes lost overnight. They worry about picking the wrong stock at the wrong time. Markets can appear to be a casino where only experts or the lucky win. Financial news parades experts who claim to have the secret. They tout which stocks will soar and which will fall. This fuels speculation, not investing, and often paralysis. Savings sit in low-interest accounts, losing purchasing power to inflation. The truth is far simpler and within reach. The simple solution: understanding the index fund. An index fund is a type of mutual fund or ETF. It does not try to pick winners. It simply owns all the stocks in a specific market index. An index is a representative list of companies. For example, the S&P 500 tracks 500 of the largest U.S. public companies. An S&P 500 index fund buys and holds those 500 stocks. Instead of finding the needle, you buy the whole haystack. You capture the market return the index tracks. You will not beat the market, but you will not trail it. Aside from a tiny cost, no predictions required about which companies win or fail. You are betting on the long-term growth of American business as a whole. One share spreads your money across hundreds, even thousands, of companies. If one company stumbles or even goes bankrupt, the impact is minimal. Diversification and low costs. Elegant simplicity that works. Real-world examples: the Vanguard 500 Index Fund, VFIAX for the mutual fund, VOO for the ETF, created to track the S&P 500 index. By owning one fund, you own parts of America's largest companies: Apple, Microsoft, Amazon, and many more. As of October 15, 2025, VOO's expense ratio is about 0.03% per year, roughly $3 per $10,000 invested. Many active funds charge around 1%, about $100 per $10,000. That fee gap compounds into a big difference over decades. Vanguard Total Stock Market Index Fund, VTSX, Mutual Fund, or VTI, ETF. It aims to track virtually the entire U.S. stock market, large, mid, and small caps. You own a slice of thousands of companies. VTI's expense ratio is also around 0.03% per year, a single simple decision to invest in the collective success of the U.S. economy. Simple, diversified, low-cost, accessible to everyone. Long-term returns are the engine of wealth creation. Historically, the U.S. stock market has returned around 10% a year on average, including dividends. That's an average. Some years up a lot, some down. Over decades, owning the market has been a reasonable benchmark. Now meet the enemy of returns: cost. Small fees can quietly eat away your gains. Consider two funds tracking the same index. Fund A costs 0.04%. Fund B, an active fund, costs 1.04%. That 1% sounds trivial. Compounding makes it devastating over time. Over 1 year, small. Over a lifetime, huge. Example: invest $10,000 in each. Assume 7% gross annually for 30 years. Low fee net's about $75,400. High fee about $57,400. An $18,000 hit, nearly a quarter loss to fees. Starting your investment journey does not require a finance degree. It takes a simple, actionable plan. Step 1. Open an account at a low-cost brokerage. A standard taxable account works. A Roth IRA can be even better for retirement. Step 2. Choose an asset allocation. Stocks versus bonds. A common start: 80% stocks, 20% bonds. For stocks, a total market index like VTI. For bonds, a broad bond index like BND. Step 3. Automate contributions monthly or every payday. Dollar cost averaging removes emotion and avoids market timing. Once set, largely ignore it. Do not panic in downturns or chase booms. Review yearly to keep your allocation on target. Then resist tinkering. Simplicity. Discipline. Long-term perspective. Take the first step today.